Have you ever wondered how options trading works? Well, today is your lucky day because you are about to discover the ins and outs of this intriguing world. Options trading is a key part of the financial markets, allowing investors to speculate on price movements or hedge their positions. We'll be exploring some essential terms such as call options, which give you right to buy, put options, the right to sell, and option premiums, the price you pay for these rights. So buckle up and let's dive deep into the world of trading. And stay tuned, because in the second part of our options trading video, we will be exploring the option Greeks, 5 factors for measuring risk. To start with, it's essential to understand the basics. What are options and how do they work? Well, options are contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a certain date. A call option gives the holder the right to buy the asset, and a put option gives the holder the right to sell it. Now, what about option premiums? An option premium is the price that the buyer of the option pays to the option seller. It's determined by several factors, including the underlying asset's price, the strike price of the option, the time remaining until expiration, and the volatility of the underlying asset. Now that you've got the basics down, it's time to get into the strategies. Options can provide flexibility and leverage in your trading strategy, but they also come with risks. Stay tuned for more on that. Trading strategies are what make options trading exciting. Let's explore some of them. We'll start with buying calls. This is a bullish strategy where you believe the price of a stock is going to increase. For example, if you think that the price of the XYZ company's stock, currently at $50, will rise, you could buy a call option to purchase the stock at $55. If the price rises above that, you're in the money. Next up is buying puts. This is the opposite of buying calls, a bearish strategy. You believe the price of a stock will decrease. Let's say ABC company stock is trading at $100. You believe it's going to fall, so you buy a put option to sell the stock at $95. If the price drops below that, you're making a profit. Moving on, we have covered calls. This is a neutral to bullish strategy where you already own the stock. You sell a call option against it, effectively reducing your cost basis. For instance, if you own stock in Def Company bought at $70, you could sell a call option with a strike price of $75. If the stock price stays below $75, you keep the premium and still own the stock. Lastly, we have spreads. This is a strategy used to limit potential loss. You simultaneously buy and sell options of the same class but different strike prices or expiration dates. For example, with GHI Company's stock at $60, you could buy a call option with a strike price of $65 and sell a call option with a strike price of $70. The sold option helps offset the cost of the bought option, reducing your risk. These strategies provide you with a wide range of opportunities, but what are the advantages? Options trading offers several advantages that you should be aware of. Let's start with leverage. When you trade options, you're controlling a larger amount of stock for a fraction of the price. This means your investment can go further and potentially yield higher returns. Next up, flexibility. Options give you the ability to profit whether the market is going up, down, or sideways. You can use different strategies to adapt to market conditions and your own risk tolerance. Now let's talk about downside protection. With options, you can hedge against potential losses in your stock portfolio. For example, if you own a stock and you're worried its price might fall, you can buy a put option to protect your investment. So as you can see, options trading can offer leverage, flexibility, and downside protection. However, it's not all rosy. There are risks and considerations that you need to be aware of. In the world of trading, risk is always a factor. Let's look at some risks associated with options trading. First off, time decay. As the expiry date of an option approaches, its value decreases regardless of the stock's price. This is known as time decay. So time can be a friend or foe in options trading. Next up, volatility risk. The more volatile a stock is, the riskier the option. High volatility can drive up the price of an option, but it can also lead to substantial losses if the stock's price swings in an unfavorable direction. Lastly, liquidity concerns. Options with little trading volume may have wide bid-ask spreads, making them less attractive. This liquidity risk can impact your ability to exit a position at a favorable price. While there are risks, a well-informed trader can navigate these challenges effectively. Options trading is a fascinating world filled with opportunities and risks. We've explored the basics, from call and put options to the premiums involved. We've delved into strategies like buying calls, buying puts, covered calls, and spreads. We've weighed the advantages like leverage and flexibility against the risks, such as time decay and volatility. Remember, knowledge is power. So keep learning, keep trading, and don't forget to subscribe for more informative videos like this one. Until next time, happy trading. Happy